more supply. We need somebody like you to take the risk, pull the trigger, and make some money. I can do all of this in about 30 minutes and decide, based on some real data, am I leaning towards or away from a particular market?
How fun is this?
It's a high-level market analysis and how you can use it to make a decision to potentially make some money. I would like to do the most obvious shout out that I've neglected this entire time.
Top producer Todd Humphreys, I presume.
No, I mean, we've talked about him a lot.
I know. Yeah.
You know who our most dedicated listener is?
Dad.
My wife.
Autumn. Yeah.
My wife.
Yes.
Every week we publish, and either on Monday or Tuesday, I get the same text. Great podcast.
Awesome. Yeah.
That's like right. My wife. She listens.
We love you, Autumn.
Yes, we do.
Okay, well, welcome to Commercially Speaking. I'm Timmy, ADHD.
And I'm Bo Barron, CCI.
Bo is managing director, owner of Barron Commercial Group. Been doing this for how many years, would you say?
Yeah, about 20 now. And Oof. Timmy here is an actor and a comedian.
That's right, SAG-AFTRA.
SAG-AFTRA, baby.
I was on Chicago Fire once.
I've seen that episode a few times.
All right, well, I've got a quick card trick for you.
Okay, let's do it.
Just make sure this looks nice and shuffled up.
Well, that was even just nice how you did that.
I know. I wanted
Until
to show you that
that
too.
happened.
Well, this is called the slop card trick or the messy card trick.
Is that right?
Yeah, so basically I'll just take a few of these, flip them over. So I'm just going to flip.
Oh, see, that makes me uncomfortable.
Uh-huh, yeah.
Oh, yeah. See,
Yeah,
like I felt that in my gut.
Well,
like
feel it when I show you, right?
Okay.
Boom, yeah, feel it when I show you. Yeah, see?
Okay.
A little mixed up. Even that. Okay, so I just want to show you. I'm just going to flip that over because I think it'd be cool to do this. Except for those four. Hold on. What do we got here?
No. What?
No way. Huh? Told you it was quick.
That was...
Oh, man, yeah, you got all anxious, too, with the mixed-up deck.
Yeah, that was good. That was really good. Okay, so here's
Sure.
my analytical mind trying to figure out how you did that.
Yeah, I can't wait.
The only way I can conceive that could possibly work was that the deck had to be prearranged, and what you did was totally pre-planned, but it did look messy and sloppy, and I didn't pick up on any of it.
Mm-hmm. And I showed you all the cards at the beginning, too. So
it wasn't in any kind of order ahead of time?
So the deck was not in any order. I was making sure that it was a shuffled deck, and I wanted you to see that it was a shuffled deck as well.
So those four aces weren't together when you started?
Now, I can tell you that I knew where the aces were.
Okay.
Okay? But the deck in itself was not set in any way.
Huh. Okay. That was cool.
Mm-hmm.
That was like do it again.
You want to see it again?
Can you do it again?
Yeah, I can definitely do it again, but...
No, let's just get to it.
Yeah, let's get to it. And for all of you that are listeners, like our brother Jay, there is a visual aspect to this podcast. So if you notice, I've been doing some magic tricks. They're a little bit more interesting on YouTube or Spotify.
Where you can see the videos. That makes sense.
We've got ourselves a nice YouTube playlist now from these last 3 episodes and this one.
Yep.
A market analysis playlist where you could go and watch all these episodes. I'm leading up to, what do you teach me today?
So this is the conclusion of the market analysis.
Yeah, baby.
So we ran a contest.
Mm-hmm.
We had our listeners and viewers, they submitted markets that they wanted us to do a market analysis on. And so Scott Carlin won. Whoa. And he submitted Palm Bay, Melbourne, Titusville,
Palm Bay,
Florida, which is the Space Coast. We've done a market analysis on that Space Coast area. And so today we're going to finish up that market analysis and draw some conclusions and actually demonstrate what you can do with this information once you get it. Because just knowing all this stuff about a market, it's like, so what? Unless you can make some good decisions to potentially build wealth and make some money. Right? I mean, there aren't very many people that are in commercial real estate to lose money or to break even, right? This is a type of analysis that can lead you to making really wise and profitable decisions. So
Great.
So let's do a little bit of review on what we found out about the Space Coast last time.
The last 3 episodes kind of bode.
Yeah, so I did
the
demand side and how you get demand numbers. So dealing with the people that create the demand for the space. How can you learn about that? And there's some tools out there, and we looked at some of those, like Site to Do Business.
Yeah, he demonstrates Site to Do Business with that one. And then we did.
And then the next episode was on supply, and we used Moody Analytics and their Market Pro product to pull supply side information. And we took a look at that, and we found a lot about the actual space itself. Rents, occupancy, we looked at all that. Last week, we actually took that information on both sides, the demand side and the supply side, and we started to look at the Space Coast MSA, that area itself. And we did an economic base analysis of it. I introduced you to shift share. We did a shift share analysis of it. We took a look at the market cycle and found out all this information. And it went a little long, so we cut it off, and we're going to do the conclusion of that analysis now.
Great. I got an ADHD thought I got to get out.
Okay.
Shift share.
Yeah.
Yeah. I just giggled when you said that because this might be most of Europe, but in Ireland, if you are making out with somebody, it's called shifting. Yeah. Right. I learned a lot of these really cool things being married to an Irish. It's called shifting. They're in the corner shifting. You know, where's Donna? She found that boy shifting. She thinks she's too good for what she really is now, doesn't she? Shifting. So you said shift share analysis, and
no, I got you. I'm just trying. I'm trying to think. Like I see no connection between making out with somebody in the corner of the room and shifting. Like what is?
I don't know.
You don't have any. Like
I don't know the
term.
Yeah, no, I know none of that. I would just assume the tongues are shifting because it's specific to make
saliva from one person to the other.
Maybe that's what it is. They're shifting. Could be. Let us know if you know. Let us know in the comments.
Yeah, I'm strangely interested in where that came from.
Well,
I did want to say one thing. Last episode when we were talking about shift share and we were looking at the regional shift numbers by sector, so jobs gained or lost based on regional shift. And we had that one, I think it was the healthcare sector, and they had the regional shift number was negative 3,808. Now, one interesting thing is you have all those retirees going there, and they've actually lost 3,800 jobs in healthcare and social assistance.
You would expect it to go the other way.
Yeah.
Right.
So nationally, it should have grown 1,250 jobs just because it's in the United States. The industry is growing, but something about it here isn't. Now, overall, they had gained 10 jobs over those 5 years.
Okay.
As I listened to it, the way we were talking about it is they actually lost jobs. They didn't lose jobs.
Yeah, good clarification.
But the regional shift number was negative because the growth was attributed to the fact that the industry grew and jobs grew nationally overall.
Yeah, so what does that number actually mean then?
It means that they don't have any kind of comparative advantage. They didn't get more than their share. In fact, they might have some sort of comparative disadvantage where if they did have comparative advantage, you would have expected much more job growth over those years.
Yeah.
And they didn't have that. They basically remained flat. And another thing that I didn't explain very well regarding shift share was the analyst, whoever is doing the analysis, can decide what years they're going to look at. So we chose 2019 to Q2 of 2023, which is the most data that we had. So I wanted to see, okay, let's go from pre-COVID till now. You could just look at the last 2 years or the last year.
Oh, okay.
Or you could look from 2010 to 2018. You can look whatever you want, and based on that, it'll tell you different things. So shift share is always looking in the rearview mirror. It's always looking at the past to give context to what's going on right now. But the numbers will change based on what years the analyst chooses to analyze.
Gotcha.
Or in other words, if I'm the analyst, I'm going to run it for different time periods and see what it tells me.
Gotcha.
Okay.
Yeah.
We didn't take the time to do that.
You just had that window of time that was...
Yeah, and so in the Space Coast over the last 4 or 5 years, their job growth in the healthcare sector has remained flat. They've actually added 10 jobs there.
Okay, cool. Got it.
Anyway,
Thank you.
So here's some, let's just review the Space Coast market. Okay. We saw average rents of all markets were $1,464 a month. Okay. Class A, Class B, Class C. All of that combined, the average was $1,464 a month. Okay. Do you remember what the overall market vacancy was?
4.6.
4.6%. And then we also looked at historical data, and we concluded, as the analysts, that their equalized vacancy, or their vacancy at equalization, where rent is neither growing or declining.
The vacancy needed for the market to work efficiently?
Yes.
Was
We decided 5%.
5%.
Okay. So the amount of vacancy in the market right now is a little bit lower than their long-term average, or what they need to operate efficiency at 5%. It's pretty close, but it's still lower. Okay. We did the shift share, which we just reviewed. We also did economic base analysis. And we do economic base analysis by distinguishing between basic and non-basic jobs. So if you would, remind me what the difference between basic and non-basic jobs is.
Basic job exports goods and brings new dollar bills into the community.
Yes, goods or services.
Non-basic job basically circulates dollars, and they serve the community that they're in.
Yep. If you've got a garden in your backyard and you grow tomatoes and you go to the local farmer's market and you sell your tomatoes on Saturday mornings, all right, you're not exporting those tomatoes out. You don't make enough tomatoes to export them to another market, even if they're awesome. You're just selling them to locals, and they're paying you with dollars that are already in the market, and you're circulating those jobs or those dollars. And every time they circulate, what happens to them?
They dwindle.
Why?
Because of taxes, savings, and investments.
Yes. So some of those dollars actually get taken out of circulation. Some are paid in taxes, some are saved, some are invested. And those dollars, as they circulate, dwindle, which means it's so important that those basic jobs exist so that they can bring those new dollar bills in the market. So that bucket of the local economy with that hole in the bottom doesn't run out of dollars. So we need those basic jobs. So we segment the market between basic and non-basic jobs, and then we can figure out what the economic base multiple is. Now, explain to me what that is.
If we've got basic jobs, they create a certain number of non-basic jobs, right? So if you get a job announcement that this certain number is coming in, that means you can expect even more jobs than just those basic jobs coming in to be needed to come.
Or let me ask you this. What's the formula for economic base multiplier? Do you remember?
No.
So the numerator would be total employment. How many total jobs are there?
Yes.
And the denominator is the amount of basic jobs that are there.
Okay.
So let's say you have 100,000 jobs in the market and you have 20,000 basic jobs. The economic base multiplier would be?
What was the number of total jobs?
100,000 divided by 20,000.
Yes.
The economic base multiplier would be?
50,000.
Say 5.
Just 5,000 would it
5.
be? Yeah.
Just 5.
It would be 5.
100,000 divided by 20,000 is 5.
Yes.
5.
Yes. So, even simple math.
We understand. You're not here for your math skills. We understand that.
Yeah.
Okay.
Okay.
So what that tells us is for every one basic job that's created, 4 non-basic jobs are created. Or for every one basic job in this particular fictitious market, there are 4 non-basic jobs.
I can tell you what 4 is. The economic base multiplier.
5 is the economic base multiplier.
Yes, right.
Because it includes one basic job.
Right.
And the rest are non-basic jobs.
Yes.
Okay,
yes.
Great. So in this case, we went to 3-digit NAICS codes, and what we found was there's 4.92 was the economic base multiplier, so almost 5. So for every one basic job, there are 3.92, or almost 4 non-basic jobs created, just like the example we used. But then we also had a hole in our data. And it was all those space jobs, which is NAICS Code 925.
Yeah.
We had no data on the 900 level of NAICS jobs, like the government, public administration jobs. So
before we move on, because NAICS, what we're talking about with NAICS and NAICS codes, clicked with me yesterday.
Oh, yeah?
So when you're talking about digits and 2 digits, well, Tara and I opened up a business account.
And it wanted your NAICS code.
And it all clicked with me. It was like, oh, NAICS codes are basically the industry that you're working in, right? And so because even when I was editing it too, I was like, I should have asked them, what is the 2-digit NAICS code? What does that even mean?
And so you had to come up with your 6-digit NAICS code.
Right. So that would be like the umbrella of a certain industry. And so when you dig deeper or get more specific with what you do,
or disaggregate, that's the word.
Disaggregate, then those are lower digit NAICS codes.
Those are the NAICS codes with more digits.
With more digits,
right?
Yes.
So a 3-digit NAICS code is disaggregated from 2-digit NAICS codes, which just mashed up data, right?
Right.
So when you go from 2 to 3, you get more specific. You break it up into smaller categories. And then when you go from 3 to 4, you do it again. At 4 to 5, you do it again. 5 to 6, you do it again. And those get really, really specific.
Yes.
So a 2-digit NAICS code might be construction. 3-digit NAICS code might be heavy construction. Road construction might be a 4-digit NAICS code. All the way down to 6-digit NAICS code might be a paving company.
Right.
So it just gets more and more and more specific.
Right.
Yeah.
Right.
That's
Cool.
great.
Thanks for doing. Yeah.
And
I'm
those
sure some
NAICS
listeners are like, what?
stands for North American Industrial Classification System.
And that's basically for the IRS and the government.
And it was created, I think, in 1997 when the NAFTA, North American Free Trade Agreement, was ratified between Canada, the United States, and Mexico.
Okay.
So they came up with this classification system to classify all the jobs in those 3 countries that entered into that free trade agreement.
Gotcha. Yep. So that window of time that we were looking at, you couldn't get data from before 97?
You can't get NAICS codes before 1997. Okay. Before that, we had SIC codes. Same thing. It was just a different classification system, and it didn't include our trading partners to the north and the south.
Okay.
So you can still look up SIC codes.
Yeah.
They still exist, but they're not really used anymore.
Gotcha, because now we got NAICS. Okay, cool. Thanks for that brief little thing on NAICS.
So our economic base multiplier for the Space Coast, because we had this gap in the data, we went and took that 4.92 economic base multiplier and we reduced it some to be more conservative, because our presupposition was there's going to be a lot of basic jobs in these space jobs that we don't have the data on for whatever reason. There was a hole in our data. So because the denominator in the economic base multiplier equation, the denominator is the basic jobs, and we expected those to grow. Right. That would actually take your economic base multiplier and decrease it. Right. So we went from 4.92 and we just guessed, and we're going to use 4.2. 4.2. So that's the economic base multiplier that we're going to use. All right. Then we also looked at and figured out the population to employment ratio. Now, do you remember what that is?
Yeah, population divided by employees.
Yes. Yeah. So there are more people in the market than just the employees. They might have spouses who don't work. They might have kids who aren't part of the workforce yet. There might be elderly people who are no longer in the workforce, but they live in that market and they create demand for space, even though they're not working. So you want to figure out what that ratio is. And the PER, or the population to employment ratio for the Space Coast, was, do you remember?
2.63.
2.63. Very good. Then we looked at the market cycle. And what did we decide multifamily was for the Space Coast?
It was at 13.
All right, it was 0.13 on the graph, which is in what quadrant?
Hypersupply.
Hypersupply, that's exactly right. And what does hypersupply tell us? The fact that multifamily in the Space Coast is in the hypersupply quadrant, what does that tell us?
They got a little bit more than their average, long-term average vacancy, or their equilibrium.
what it actually means is if you're in hyper supply, your long-term average occupancy, and we decided that number for the Space Coast was 95%, right? 5% vacancy, 95% occupancy.
Okay.
They're above that, or they have a little bit more occupancy than they traditionally do. Long-term average was 95%. They have 95.4%. So they're just a little, or if you want to flip it and say it the other way, if they need on average 5% vacancy,
Yes.
they're at 4.6. So they're just a little bit below.
Right.
Okay. But in this case, the market cycle graph is built on long-term average occupancy. So 95% occupancy. They're at 95.4, which means they're going to be above in one of the top two quadrants, either in expansion or in hypersupply. And if they're in hypersupply, if they're coming down on the graph, that means their rent growth is declining. Rent could still be growing, getting more, but the pace of the growth is declining. As soon as the rent growth is declining and they fall below the long-term average occupancy, then they go from hypersupply into recession, right? Not economic recession, but that's the name for that quadrant in the market cycles.
Yes.
Okay, for multifamily. So in this case, since they're above the long-term average occupancy and their rent is declining, which we saw looking at the historical data from the Reese reports from Moody's, that puts them 0.13 on the graph in hypersupply. So that's where they are in the market cycle. That is key to note. Okay. We also looked at the executive summary just to get a feel for their overall demographics. We looked at the business summary. What we found out from those two reports was that the average household size in the space is 2.31.
Right.
Okay, we're going to need that data here in a minute. And the tenure, or the percentage of renters, was what?
21.
21%. So 1 in 5 households rent versus own. Okay, and we'll need that in a minute. So the two things that I want to do here to conclude this episode or this market analysis is I want to run the analysis for threshold rent and explain what that is. And then I found a job announcement from November of 2023, so just 6 months ago now.
Right.
And I want to take that information and run it through our analysis and see if we can predict some demand.
Okay.
All right.
Sweet.
And then figure out what we might do with that information to make some money.
Okay, cool.
Okay. All right.
All right. And we're back and we're live recording. Thank you for listening to 97.1 FM The Drive.
All right. So here's my nifty little threshold population spreadsheet. Not threshold population, but threshold income or rent.
Threshold rent.
Rent. If people make a certain amount of money, they can afford a certain amount of rent. So you can start with the rent, or you can start with what they make and back into the rent. You can start either way. Okay. So we know what the average rent is. It's $1,464 per month. Right. So I'm just going to round up to $1,500. All right.
Thank you.
You're welcome. And so I'm going to put in estimated monthly rent, $1,500. Okay. Now, monthly expenses. These are housing expenses, utilities, renter's insurance. What would you think?
Groceries?
No,
not
just
like
living
having
expenses,
to do with a house.
but like housing expenses, like maybe what?
$500-600?
Probably pretty heavy. If we're just talking about like renter's insurance for apartments and utilities.
Utilities.
So let's just do maybe 300.
Okay, let's do 300. Okay.
So what this tells us is our total monthly housing expenses, $1,800 a month. If we multiply that by 12, our annual housing expense is $21,600. Right? That's what we're going to spend. Now we're going to make an assumption here, and this is one of those assumptions that you would have to look into the market and bear this out. Okay, make sure that we're good.
Okay.
But let's just say their housing expenses average around 35%. Okay, so we're gonna take that 21,600. We're gonna gross it up, which means you're gonna divide by 35%. So I'm just gonna put in 35% here, and that means that their disposable income would need to be $61,714.29
Okay.
for them to afford $1,500 a month in rent with $300 a month housing expenses, utilities. Okay. Now we have to gross up again based on the tax rate. We're just going to make an assumption here that the tax rate is 32%. And so we're going to divide by 1 minus the tax rate. All right, so I'm going to put in the tax rate here of 32%. And what that gives us is $90,756.30. So if the tax rate is 32%, if that's a number that makes sense for the Space Coast, I have no idea. Mm-hmm. We'd have to figure that out if we're going to do this in real life. Yeah. If that number is right, and if a good number for housing expenses is 35%, if that's true, then to afford $1,500 a month in rent with $300 a month in housing expenses, you need to make almost $91,000 a year.
Okay.
So if I'm a developer and I need to get $1,500 a month for my development to make sense, I need to be able to find tenants that'll pay $1,500 a month. I need to go and build it in a place where I can attract people who want to rent that make $91,000 a year.
Right.
That's what this tells me.
Okay.
You could do this in reverse and say, all right, the market I'm looking at, the median household income is $80,000. Mm-hmm. And so you just work these in reverse, and you would say, and you would figure out, it's, they can afford $1,400 a month.
Right.
Right. And that, as a developer or as somebody who might want to invest in existing property, buy multifamily in this market, that would give you a feel for what the market can afford.
Right.
Okay.
Okay, cool.
So let's take a job announcement, and let's take that information, use all the information that we've gathered, mm-hmm. and draw some conclusions.
Okay, great. Okay.
Space Coast Economic Development Commission joins Dassault Falcon jet for Melbourne groundbreaking. Okay, so this is November 2 of last year. They're going to make a capital investment of over $100 million in the creation of 400 new jobs. Okay.
What kind?
Well, let's read a little bit of this article, and let's see if we can figure out if these would be basic or non-basic jobs.
Okay.
So, the Economic Development Commission of Florida's Space Coast was proud to join Dassault Falcon Jet, including CEO, that guy, Thursday morning at the Melbourne Orlando International Airport for the company's groundbreaking celebration of their Melbourne location. Dassault Falcon Jet Melbourne joins our growing international aviation and aerospace cluster, making our community even more competitive with our proven resources of a highly skilled workforce, infrastructure, and supply chain. By the way, those three things, highly skilled workforce, infrastructure, and supply chain, those are comparative advantages that the Space Coast has over markets that don't have those things.
Right.
And so because of those comparative advantages, you would expect them to do better when it comes to space and aviation type jobs.
Okay? Right. Okay.
So EDC first announced the company's selection of the Space Coast in October 2022. Dassault Falcon Jet selected Florida Space Coast for this new major maintenance facility, which will spur a capital investment over $100 million in the creation of 400 new jobs.
Sounds like basic jobs to me so far.
They do sound like basic jobs. This new state-of-the-art facility will spur creation of new jobs. Average annual wage of those 400 jobs, $86,120. Uh-huh. So we're right at that threshold number of income for them to afford the average rent of an apartment in the Space Coast.
Right.
Right. They're right there.
Yeah.
Okay. So that's good to know. It's intended to serve customers across North and South America and beyond.
There we go.
All right. So are these basic and non-basic jobs?
These are basic jobs.
Okay. Let's just make the assumption. All right. This is a little bit simplified. Okay, but let's just make the assumption at this point that these 400 jobs are all basic. They're probably not. You've probably got some janitors in there. You've probably got some jobs that if you looked at those jobs specifically, you might say those aren't basic jobs. But let's just take that 400 number and assume they're basic jobs. Okay. And let's run our economic base analysis and see if we can predict how those 400 jobs might affect demand for multifamily in the Space Coast. Because I think its opening is set for late 2024. Okay, so later on this year, this facility will open. Those 400 new jobs haven't hit the market yet.
Yeah.
They're coming pretty soon in the next 5-6 months. I'm not going to read the rest of this article, blah, 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 but
yeah, we got the information we need for our purposes.
got the information we need for our purposes. That's exactly right. We've got 400 new jobs. Well, let's do some math.
Okay.
All right.
We need our
We're going to say those. Do we what?
Go ahead. I was going to say we need our multiplier.
Yep. We're going to take 400. Those are basic jobs. And what we want to figure out first is how many total jobs will these 400 basic jobs create? Mm-hmm. And what's our economic-based multiplier that we're going to use for the Space Coast?
Was it 5?
It's 4.2.
4.2. That's right.
4.2.
4.2.
So we're going to multiply 400, which is basic jobs, by 4.2, which is our economic base multiplier. And when we do that, it comes out to...
It was a little over 1,600.
A little over 1,600. So let me just be exact and not do this in my head and embarrass myself. 1,680 jobs. So those 400 basic jobs become 1,680 total jobs.
Mm-hmm.
We got to go from total employment to total population.
Right.
And to do that, we use our PER, our population to employment ratio, and that was 2.63 was our PER.
Okay.
So we'll multiply 1,680 times 2.63, and it comes out with 4,418.4. We'll just throw away the 0.4. That's total population.
4,418?
4,418. Or in other words, those 400 new jobs are going to create new population in the Space Coast of 4,418 people.
Gotcha. This would be our added population based on these jobs.
Mm-hmm.
Yep. Cool.
Now, people don't rent apartments.
No.
Who rents apartments?
Households.
Mm-hmm. So to go from total population to total households, we have to divide by what?
Their average household size, which is right?
So we're going to take 4,418 and we're going to divide it by the average household size of 2.31, which gives us...
Now, you're saying total population. Is that what this number is called? Are we saying total population as... Because when I think of total population, I think of everybody in this area. But
this would be total new population.
Total, okay. Yeah, just want to clarify. Okay, cool.
Good clarification. Cool. So we're going to divide 4,418 by 2.31, and that gives us 1,912 and a half. We'll just throw the half away. 1,912 new households because of 400 new jobs by this jet company.
How fun is this?
So that's great.
Smash that like button.
This 1,912 new households, are they all going to rent?
No.
Now, some of them will buy.
Yeah, but like 1 in 5.
Yeah, so it's 21%.
21%.
Okay. So we're going to take this 1,912. Mm-hmm. We're going to make an assumption that the current amount of percentage of renters versus owners in the Space Coast will hold consistent with the new population and the new households. And we're going to take that demand and we're going to multiply it by 21% to see out of these 1,912, how many of them will be renters. Mm-hmm. So let's multiply that by 21%.
Would you make that assumption nearly every time?
Yeah, I would.
Yeah, okay.
At least at first until we had information that would suggest otherwise.
So I just assume a bunch of new jobs coming in, not everybody would buy right away.
Mm-hmm.
A lot of people, it just seemed like more people would rent than what's at first, at least. But okay.
So you could tweak it based on understanding the market a little bit better. Mm-hmm. You know, Scott Carlin, who suggested this Space Coast area,
whoop, whoop.
He might say, "Ooh, no, we know just based on knowing our market that the people that have moved here over the last year, like 40% of them are renting first or whatever." So he may know different, but I would start using the same percentage as the market gives. And this tells us that there are 401 of these households will be renters.
Okay.
So that's economic-based analysis right there.
Mm-hmm.
All right. We're looking at the market. We're saying because of 400 new jobs, there's going to end up being 1,680 new total jobs.
Mm-hmm.
Then that's going to create new population of 4,418.
Mm-hmm.
Based on the average household size in this market is going to be 1,912 newly formed households.
Mm-hmm.
And of that 1912, 401 of them are going to be renters.
Well, that's simple. 400 new jobs means 400 new renters.
Well, it does in this case.
In this case, yeah.
But I rarely see it work out that way.
Right.
If you have an economic-based multiplier that's higher or lower, that would change that. If your population-employment ratio isn't what, if your, percent renters, I've never seen a market as low as 21%. Normally, you're seeing like 30 to 40%.
Right.
So that would all change this. But in this case, 400 new basic jobs ends up being 401 new renters.
Yeah.
And then you take a look at the market and you say, well, how many housing units are there? How many multifamily housing units are there? Well, when we looked at the historical data from that spreadsheet we downloaded, we know exactly the number. It's 21,158. They're 4.6% vacant, which means there are 947 vacant units. Now, what I don't know at this point is, are those Class A, Class B, or Class C units?
Mm-hmm.
Don't know. Okay. We've just aggregated it all up. A next step here would be to disaggregate those supply numbers and see what's available. And these people earning almost on average $90,000 a year from these new jobs, they can afford about $1,500 a month in rent. Are they going to rent Class C apartments? Say no. No, they won't.
No,
They're going to want nice B plus, maybe A properties, and then you take a look and see what's available.
Yeah.
With that disaggregated supply data.
And then, do we know that if those vacant units are up for sale or for rent? Do we know that?
The vacant units are for rent.
The 947 vacant units are up for rent. We know that. Rent. Yeah, okay.
So if all 401 of these folks rented, it's going to eat up about 40% of the vacancy. And that vacancy will drop from like 4.6 to under 3%. What would that likely do to rent growth?
Go up.
It would put upward pressure on rents.
Yep.
Okay. Because there would be more demand. It would firmly put the market above the long-term average occupancy, right? Mm-hmm. And so you could actually see potentially that it's in hyper supply now. It might go back up to maybe expansion. You might actually see it go backwards a little bit.
Yeah.
And at this point, you may think, well, if we need to have 5%, then somebody needs to add supply to the market to help with this demand. And as a developer, you might decide that could be you. Would you want to build right now in the Space Coast based on this market?
I'd say the risk is relatively low to begin building at this moment. There'd be a couple more things I'd want to look at, like the pipeline, right?
Yep.
But I think, if there's not much in the pipeline, I would think about building. And I think about building. Well, I mean, it takes a while for those developments to be complete.
Sure does.
So,
I mean, it could take 18 months, 2 years.
Right. Where are we going to be at that point?
It's a great question.
Right. Well, where we are in the market cycle, that right now my gut's telling me, pull the trigger.
So I would consider some things like, right, interest rates. We came into 2024 thinking that the Fed was going to cut interest rates a number of different times, right? They've come off that now.
Yeah.
Right. So we might have 1 or 2 rate cuts, maybe none. The interest rates being where they are, some people are forced to rent because they can't afford what they want. They're not buying. So there's that dynamic that can create demand for multifamily. You've got a market here that's in hyper supply. And we just looked at what would 400 basic jobs, like we see that by the end of the year, they're going to have 400 more basic jobs there. Okay. But what we didn't do is a comprehensive search on job announcements. It could be much bigger than that.
Right.
Right? Let's say we do, I did a Google search and I stopped at the first job announcement I found.
Right.
And it was that one, it was 400 jobs. Well, let's say we look at it and we can determine that over the next 12 to 18 months, there's going to be 4,000 jobs.
Right.
Well, let's just make sure the math holds true. If it's 4,000 basic jobs, and you multiply that by an EPM of 4.2, and then you multiply that by a PER of 2.63, that would give us total new population of 44,184, right? Divide that by the average household size of 2.31, and then multiply that by 21%. And now we have that extra zero drops all the way through. Now you have demand for 4,000, actually 4,016, 4,017 new renters, new households that will rent. And if that's the case and you only have 947 units that are vacant in the market.
Ooh, I don't know. Let's build.
Now it's a question of how much do we build? Are there 10 other developers that are going to figure this out and compete with me?
Right.
If there's 4,000 new renters coming to the market and we only have vacant supply to handle a quarter of them, I might want to just capture maybe 10% of that demand. Mm-hmm. So maybe we build something that has 400 units. That way, if 10 other people have the same idea and they all build 400 units, then we haven't just totally overbuilt the market.
Right. We're getting a piece of the pie.
Yeah. But maybe there's a job announcement that goes the other direction. Like this place is closing down. 500 jobs are lost. Mm-hmm. And those were basic jobs. Well, you would just take this off because this works in reverse.
Right.
And so you would be analyzing the market at a much more comprehensive level.
Right.
Trying to decide, man, is demand going to be there? But if you knew, like economic-based analysis tells me that because of those 400 jobs that are basic jobs, alone, there will be demand for another 401 apartment units. Can you make money with that? Potentially.
Yeah.
Right? It's not a huge number, okay?
Right.
But that's real demand that's coming that's not there today.
Yeah.
And it will affect the dynamic in that market.
Right.
Now, if it's a 4,000 instead of 400 and you're not seeing any closures or whatever, and if you're a broker, I'm calling developers. Mm-hmm. And I'm calling people that have land that could be developed as apartments. I'm giving them this information. Hey, look, we've got demand coming for 4,000 new multifamily units. We need more supply. We need somebody like you to take the risk, pull the trigger, and make some money.
Yeah.
And that's how you can use this information to potentially make money.
As we do this, I am thinking all through the lens of a developer. Mm-hmm. If we were to put on the lens of an investor, what would this tell us? And what I mean is not just like I'm going to invest in someone to develop. I'm an investor looking to buy multifamily.
I would be thinking of a few things. One, if we can see that there is some significant demand coming, but we're in hyper supply right now, I would expect us to roll through hyper supply into the recessionary phase and then get to the recovery phase, maybe kind of quickly, okay? Because that demand will push us through that pretty quickly and put upward pressure on rent. So I could start to forecast some rent growth, which they didn't see in the last year. Mm-hmm. If you remember, I think their rent declined by 4.5% after 2 years of double-digit increases.
That's right. There's a lot of development that came through, and then
Yep. So now, maybe by the time I introduce my new supply to the market, we're back on that upward trajectory of recovery into expansion. Okay,
right.
That's what I would want.
So this could potentially mean this is a good time to buy if someone's selling. This might be a good time to buy because it looks like the rents will be going up and not too far in the future.
If you can look at the market and see, look, we've got strong, stable population growth, which it has seen. Mm-hmm. If we've got some job announcements where we can predict the basic, non-basic, total employment, total population, average house, if we can run that analysis and see, man, we can really quantify that there's going to be demand for more units. If you're an investor and you don't want to build the new units, you just want to own what's there, Well, that new demand is going to put upward pressure on rents.
Right.
And if you look at the interest rates and you say, well, if we think these are going to stay higher for longer, then that increases demand for renters because people aren't buying because it costs more to borrow.
Right.
Then all that would put upward pressure on rents because it would increase demand for the units. All that might make me like the Space Coast for multifamily investment.
But you still want to look at the pipeline, because if you see all that and you see, oh, there's a lot in the pipeline, we are going to quickly equal out, if not have too much supply.
Yeah. Absolutely.
Yeah. Okay. Yeah.
That's how you can quantify demand. And by using economic base analysis, also using information from our supply side tools, our demand side tools, the market cycle analysis, long-term average occupancy, all those things, you put it together and you can start to make some decisions on a particular market. And so when we invested in those Dallas apartments, we did this. And what we saw was really strong job growth over an extended period of time. We also were able to define or locate where the path of growth in Dallas is, which is kind of to the north and to the east, and where we invested was in that path of growth, which you want to be in the path of growth.
Right. If you're like, what is that? You can watch this episode here on growth theory. It'll show you the different types of paths of growth.
And we did this, and we looked at average rents. We looked at all that stuff. And, of course, in that particular instance, we invested with some partners who are renting to legal refugees. Okay, let's say the political environment changes so that no legal refugees are let into the country anymore. What happens if that happens? Well, we want to make sure that there's still demand in the market. We had to figure out what's the market rent for these types of apartments in there. And when you looked at the downside, like no more demand from legal refugees, if we just have to get our demand, our renters from the market in general, it still works. There was still that kind of job growth that would create that kind of demand. It was still there.
I say, yeah.
And the market rents were still there to justify the investment.
Right.
And so, like, the worst case scenario that we came up with, it still worked.
Right.
So that makes
You're going to have to rent to some natural-born Americans.
Maybe so.
Yeah,
for sure. You know, at a high level, this is how you analyze a market.
Yeah. It's crazy to me that all this was still at a high level. You know, we got deeper into the weeds than we have before, but still, like, sure. I see it. I can clearly see how much more that you can do, how many more factors you got to take a look at, where to go to, and how this is just a great jumping point.
Yep.
Right. And there's always going to be risk because you don't always know what's coming or what's going to change. And this is only to mitigate the risk of your decision.
Well, not only, but that's certainly a benefit of doing this. But,
well, sure, yes.
But think about this for a second. We did this in about 2 hours, and I was explaining it along the way. How long do you think it takes at a high level to take a look at a market?
I don't know, probably take you 30 minutes?
Maybe.
Yeah.
I can do all of this in about 30 minutes and decide, based on some real data, am I leaning towards or away from a particular market?
Mm-hmm.
And if I'm leaving heavy away, maybe I just need to do 30 minutes, and then it's like, we don't like this market.
Right.
Okay. If we're leaning towards, before we invest dollars in that market, we're going to need to dig deeper.
Right.
We're going to need to bear out some of these assumptions. We're going to need to dial some of this data.
And on the next episode,
you will be put to sleep with that. No, we're not going to do that.
No.
But yeah, man, that's a high-level market analysis and how you can use it to make a decision to potentially make some money.
Well, I thought this was dynamite.
Boom.
That's great.
Yeah.
If you thought this was dynamite, let us know in the comments. Let us know what else you would like Bo to teach me, and you as well. Hit subscribe. Hit that like button. If you're listening on Apple, please leave a review on Apple. We will shout you out, and it helps a great deal. Get this information to more people. We've got a free weekly newsletter. Subscribe.wgbarron.com.
That is correct.
And in that newsletter, you'll never miss another podcast. You'll know exactly what's coming out. It's in there in about 5 or 6 different articles on business, negotiation, commercial real estate, everything for success. And
Well, this has been fun.
yes, this has been
I
really
like
fun.
I like doing this. Maybe we'll do one of these a year or something.
I think so.
Because the next time we do this, it won't take as much explanation. We could look at a market in one episode.
That's right.
you know.
I still got the hat.
Yeah.
So you can always leave a comment and be like, market analysis on this. We'll just add it to the hat.
Yeah. And then next time,
We'll pull.
nice.
We'll pull. Yeah.
All right.
That's it. Cool. Love you, brother.
Love you, man.
All right. Bye, Alice.
Bye.